Good morning, guys. This is the Q&A session for the hybrid trading workshop for Tortoise Capital. It is August 1st, Saturday morning, 10 a.m. ish. Just a hat tip to Eugene Crowfoot and his son, who, on their way to Wyoming from New Orleans, stopped in to Kansas City overnight, and we shared a pretty special moment over at the soccer field where I've spent the last 15 years um, working with the kids to become a better person and to teach the beautiful game and learn something about leadership. And he brought a very special, deeply meaningful gift, and we got to share a pretty good half hour this morning before they had to get out on the road out to Wyoming. So it was just wonderful meeting Eugene. He's even nicer in person than he is on email, and his son is an outstanding young man. And it was pretty cool this morning. I'm still tingling from the energy exchange. It was he presented me a very nice gift to watch over me, and I gave him a few tokens of deep meaning from me. And it was nice in the time of the virus to be able to actually have a human moment. So best wishes for safe travels to Eugene on the road. Little things matter a lot. They may be the only things that actually do matter in the long run. While we were there at the soccer practice field in a little grove overlooking the larger fields, we practice in that grove in the summertime because it can be so brutally hot in Kansas. And I saw my friend, retired Brigadier General Don Cherry, with his coffee cup in hand, and a bunch of Rotarians with him from the Rotary Club. And they were out this morning at 7:30, like they always are at the 10th Avenue Soccer Park, walking around, picking up trash, and making it a safe, clean, healthy place for families to enjoy. This is a guy who's got countless decorations for bravery, multiple Purple Hearts, has a surgically modified left hand, was a medevac pilot in Vietnam, and a division planner during Operation Desert Storm and Shield. And yet 7:30 in the morning, just dressed like a little old man out there, just quietly taking care of the community where he grew up. And he comes in as a guest speaker to our classes every year. We'll see how that works this year, just to share stories from an old warrior to the next couple generations of warriors. And he's just everything that he is, you see in the way that he carries himself. The humblest, quietest warrior you could ever imagine. You almost can't even imagine him. And to see him out there just quietly contributing like that on Saturday mornings just reminds me that if duty is your highest calling, it never really stops. And I hope to grow up to be 1% of the man that he is in the future. So it was good to see him. Yeah. So on to business. So I just posted this at Patreon. This is there's the new registration link for the nightly strategy podcast for August. I can only schedule them out like 1 month at a time. That's as far in the future as it'll go. So just to review, the Nightly Strategy podcast goes from 8 to 9 every night, except for Saturdays, I should say, except Saturdays. So Monday through Thursday is a review of the daily report, and then trades of the day, and then there may be some lessons that are in there, that pertain to something that's on people's minds, or it was asked in the workshop, or somebody sent me an email where I'll just use that to share key insights. And then Friday I also review the trades of the day, but I add in the weekend report. And so that includes the setups for Monday as well for tactical trading. Then I don't do one Saturday night, but I do one Sunday or Saturday morning. That's this one, 10 to 11, although it usually goes 10 to 12. We'll see. And that one is going to stay focused on the hybrid trading Q&A, although those are starting to diminish. And so what I'm going to do is starting next week, I think I'm going to pick up the a systems thinking course that I'm building out, and I've got about 20 different lessons templated out for that. And that's going to be almost a step back from trading a little bit, but how to think in a systematic and an organized way about whatever process you're working on, whatever problem or opportunity that you're working on, how to approach it from a robust systems thinking practical perspective. So it's very strongly connected to the legacy of systems thinking, to the work of like Peter Senge and the fifth discipline, the Japanese production style, Toyota production system, the Deming management method, soft systems theory, adult learning theory, continuous improvement, that Shingo model. So that's going to be a practical approach to systems thinking. I'm probably going to cover some of the things from that today already because they're on my mind. So I've started a collaboration with a group from University of Chicago Business School. One of my former students, who's being selected, I think, for an Army PhD program, has taken some grad degree work at University of Chicago. So he and his professor have started this global collaboration on how to do mental mapping and systems thinking in this modern world that feels so chaotic. And they're looking to explore the synergy between civilian best practices and military planning and decision making. Well, that's kind of what we do in here anyway, secretly. So I kind of been setting the stage for them to understand what we do, and it gives me a chance to document some processes and whatnot. So my student invited me in, and so I'm starting to work with these guys. And there's a pretty interesting global collection of thinkers and practitioners from public and private sectors that are working in there. So I'm hoping to, battle test these ideas even more and see what we can learn from other thinkers. And so I'm going to share a few of the mind maps that I've been using to torture these guys. So you realize it's not just you suffering. So some of that material, as it gets built out, is going to go into these future Sunday morning lessons, and I'm going to call that basically the systems thinking course. I've been working through on getting certified in positive psychology from a world authority on that, and I've got 4 or 5 chunks of courseware that I'm preparing to share with you guys as well. And I will probably use the Saturday mornings lesson time for that as well. That's in the area of practical mindfulness, positive psychology, emotional resilience, things of that nature, and all of it geared towards um, helping make our life better and healthier and sustainable. So that's kind of how the I believe the Saturday morning sessions are going to shift. Um, there will always be the opportunity to do the hybrid trading Q&A there, but I intend to do more as these questions come in. I intend to do more of that. That's the same day they come in on the regular evening podcasts. Okay, so that's the registration links there, and you can actually click the links over on Patreon. I just posted it there. Okay, I will hang this in the hybrid workshop on Basecamp too for ease of use. So I wanted to start this one with the question that was asked. Let me see if I can find it again. Yeah, I briefly mentioned this one last night. So Milt, I think, did I see Milt? Yeah, Milt's in here. And just to I wanted to cover again what I covered last night. And Milt's question was struggling about when to move to no lose plus dinner for two in general. And so I want to talk about that in terms of the kata and the supported spring crossing, and then more generally about how to think about that move. Because I consider that to be the most important decision that you make from a psychological perspective, because it is a risk management, risk mitigation move. And in my view, it changes everything about how I look at the trade. When I move to no lose plus dinner for two, I have essentially taken my risk to my core capital and my emotional well-being. All that risk is gone. And that trade has simply become a science project. And that's the biggest single shift in psychology that I experience on every single trade. So I've been doing this for 40 years, and it still is the single biggest sense of emotional relief that I experience. Now, maybe that's part of, it comes from military experience and, combat experience. But every day you don't get killed is a pretty good day at work where I come from. And there is a profound sense of relief that you feel when you come back inside the base camp from a patrol or a mission. That when you get back to sanctuary and you have a chance to debrief and just recover surrounded by friends and allies and battle buddies who are taking care of the security, that is a feeling of profound satisfaction and gratification and relief. And I will tell you that on every trade, when I move to no lose plus dinner for two, I feel exactly that way. And so it becomes a pretty important moment for me. So the question then, when to move to no lose plus dinner for two, in the shaded area or the highlighted area, I'm going to talk about some principles, and I want to acknowledge what Milt says there about he gets the idea of re-entering. It's all about the will at that point. That's really true. We have a saying that re-entry is the key to sanity, and as long as you can re-enter, maybe that's the biggest obstacle to rapid exit to preserve capital. But the points that I want to make here before I go to the sketches, when you have an average win in hand, so this is not limited to the supported spring crossing, by the way. This is on, for me, this is any trade on any time frame. So whether like at the core positions, where I'm doing the monthly rebalancing, or a long-term position trade, or a swing trade, or any of the day trading systems and strategies. I know what my histogram of all of those trades for me look like, what that category of trading looks like. And I know what an average win on every one of those is. And I know what the standard deviation is. So I know what the histogram says about the difference between normal and abnormal. So if I were to draw that as a histogram, a normalish looking histogram tells you that this is a repeatable process. And so I'm going to draw as a red line the zero line should look something like this. But that's just as ugly as it can be. Okay, let's go to the other drawing template. Let's try that again. Okay, so we have oh, look how much easier that is. So there's the zero line, and we're going to call this minus 1R. So we're going to make that not quite to scale. So as you know, let me put the average line in there. .6R. So as you know, what I'm looking for in my histograms is the first thing that I look for is no losses greater than 1R. If I have no losses greater than 1R, then that means this part of I don't have anything in here. I've trimmed the left-hand side of the curve. Then what I'm looking for is between minus 1R and plus 2R. I want that to be positive expectancy. So just in the land between minus 1 and plus 2, if I have positive expectancy, then I'm being paid to trade. And what I'm looking for is a normalish looking histogram right in here between minus 1 and plus 2. And that means that I'm getting a lot of opportunities. And when I look at the bulk of my trades, not looking at the exceptional trades, but just looking at the bulk of the trades, then I have a normal looking distribution. So I'm looking for a normal ish distribution from -1 to +2R, and it is positive expectancy. That means I'm being paid to trade. So that's the second thing that I'm looking for. And if it looks normal, and the average trade is positive, then yes, I'm being paid to trade. So it's really important to me, where is the average trade? And then from average, we can take, standard deviations, and find out how normalish we are. But if it looks approximately normalish in here, like a bell curve, and it's at 0.6, then that's probably good enough. So the third thing that I'm looking for is between, greater than 2R, that there are some trades greater than 2R. Doesn't have to be a lot, but I'd like to see some trades that are out here in the fat tail, which means that I'm open to receive greater than 2 on some trades. When those happen, here's how I interpret that. It's something like, let's just call it 80% of the time normal, between -1 and +2, and then 20% of the time greater than 2. I just say that as approximations. I'm not even sure what the number is. I don't think it's even quite that good. But I really I'm getting paid to trade by these, and then I treat these as a gift. Anything greater than 2 is a gift. And so if I get a trade that's greater than 2, for purposes of computing SQN and all that jazz, I treat them as a 2R. That's what I'm entitled. That's what I was aiming for. That's what I feel entitled to count. Anything greater than that was a gift. Because I don't want the occasional amazing trade that's out here to shift my attention from my job. My job is to produce this. And then this is like the annual bonus. You don't count on it. People that count on their annual bonus as if it was theirs end up living at levels that are not sustainable. Like if the business goes under or the times are tough, you're living beyond your means. That's where stress comes from, and insecurity. So I look at that as an opportunity. Anything out here that above 2R is to do something special with those abnormal gains. And so I don't let that into my head to shift my understanding of what my professional job is. Because if all this goes away, I still am getting paid to trade. So I don't want to skew my results with abnormal returns. So I say all that in order to say what the average trade now takes on a really important meaning for me in this. So that rule that I mentioned on the last chart, if I have an average trade, by that time I should be at no lose plus dinner for 2. So if my average win is 0.6, that's not unusual, because when I frame my trade, And there's my 1R loss. And here's my my proposed mechanical entry. And I'm looking for my target up here. So that should be purple. I'm looking for, 2 scoops versus 1 unit of risk. There's my 2 to 1. I'm aiming for 2, and I'm hypothesizing that I can manage that 1R loss. That if this thing gets me in here and then immediately starts selling off, I won't take any losses greater than this 1R. So that includes a time for decision making and a little bit of slippage and some execution. So I don't want to take any losses greater than 1R. And then as long as I can see the 2 scoops up here, that's my justification for a reasonable upside target. But if my average win is 0.6, that means that I'm willing to aim for 2, but accept 1/3 of that, because 0.6 times 3 is 1.8, and that rounds to 2. So I'm aiming for 2, and sometimes I get it. But if my average trade, including all the losses, everything nets out to 0.6, I know that once I'm past 0.6, I've got an average trade or a better than average trade. By the time I get past my average win, my average trade there, I believe my stop should be up here at no lose plus dinner for 2. So if I've got an average win in hand, I should never let an average win lose money. All right? Never let an average win lose money, because not because of the dollars, but because of the psychology, because that's the one that got away. I had one in the usual way and I lost money on it. Ugh. So if I have an average win and for whatever reason it comes back and I get no lose plus dinner for 2, I feel like, hey, I still got something. I still got paid to trade. So there's that. Don't let an average trade lose money. And I feel like an average trade, you should get something for the trouble. Like, I hate scratching. Like, I did all that work and I walk away with nothing to show for it. That almost hurts more than losing a fraction. It doesn't. Kind of, you see the point. I'd like to lock in no lose plus dinner for 2. No, an average win is not no lose plus dinner for 2. An average win is the average win of that, of all the trades between -1 and +2R, gives you your average win, or your average trade, I should say. So let me say that again. So let's say that I have a win rate of 50, and I get 0.9, and 50% of the time I lose -0.3. That's going to give me an average trade of 0.6. Okay. So on a given trade, if my trade frame was this, so there's my 2, not quite to scale. Dang it. And then if my average if my average here is 0.6 and my average loss is 0.3, to get to an average trade of 0.6 that and on a 50% win rate, then my average win had to be, let's see, average win had to be 0.9. So that when, here was the previous bar or whatever, and I set up my mechanical entry. And so let's say it opens here, bang, I'm in. To get an average win or an average trade of 0.6, this thing might have gone to my average win of 0.9 and then started trailing backward. And then if it came back a minus 0.3, and then I took my exit, so now my trade looks like this. And here was my maximum favorable excursion. And so here was my risk. And that's how much I gave back. Oh, that should have been green. I'm coming out of that with an average trade of 0.6, even though the maximum favorable excursion was 0.9. So if there's my zero line, here's my average trade. .6. And that was my maximum favorable excursion. So what I'm trying to set up here is a histogram where between -1 and +2, I'm positive expectancy. In order to get to a 0.6 on this trade, I was up 0.9. And remember, I was aiming for 2. But in my view, anytime I get past the average trade, once I get up into this region, I'm saying don't let that ever lose money. That's the no lose plus dinner for 2. Right? If I get above, I would say, I just feel like if I get halfway to my goal, like if this thing goes from 0.9 to 1.0, again, not drawn to scale, I would like to have I don't want to let this 1.0 trade. So now my maximum favorable excursion is up in here. I don't like to let, if it was perfect, if that was a 1.2, I don't want to give back more than half to make this an average trade. So that's why at 1, watch what happens if that thing was 1R in your favor. If it was 1R in your favor, half of that is 0.5, and your average trade was 0.6. If I got to 1.0 and I let that become less than an average trade, I'm giving back almost half of the abnormal gains. And if I let that go under 0.5, I'm giving back more than half of an above average trade. That feels incorrect. So if this thing gets to 1.0, let me put it this way. As soon as that thing got past 0.6, I took my stop to no lose plus dinner for 2. If that thing gets to 1.0, or if it gets to 0.9, I want to move that up to an average trade. If it gets to 1.0, I'd like to have that just a little bit better. Because now most of the time, maybe 80% of the time, this thing does not go beyond 2R. So if it gets to 2R, this is where that 2R battle drill mentality comes into play. And it talks about how to preserve more of that outside. Everything beyond my average trade is beginning to be an outsized win. So I'm trying to figure out with the 2R battle drill, as it's coming into the station, how can I preserve most of this stuff? Because if let's say I could get exactly a 2R win, in my mind, that's really 3 average trades plus a taste. And that's going to take care of 3 other trades that weren't quite that good. So a 2R win is actually really, really good for me. Yeah, that's what I'm aiming for. There's some reasonable, not unreasonable possibility that it could get that far. And that's all. That's why I'm willing to aim for 2, but I'm willing to capture 0.6. Phil says, while you understand the psychological benefit of doing this, would it result in exiting some trades prematurely that could have gone on to be bigger winners, thus reducing my average win? So the key word in that question is premature. So premature is a key word which says, hey, I've had experience where things went like this. It went up in here and it came back and I took my exit, and then that thing went on and left me. And, oh yeah, that happens all the time. All the time that happens. How often does it happen? All the time. And so now the key phrase is re-entry is the key to sanity. This happens less than 20% of the time. So that means 80% of the time, it doesn't go beyond 2R and it comes back. So this little habit of mine protects me and locks in my average win, and it makes every time I get a result that's better than the average trade, it moves the average trade to the right some fraction. So now, what do we do about these opportunities that are better than 2R? Well, that's where the 2R battle drill and the re-entry allows you to get more of those and get multiple positions on them And that's where you get these category 3 trades that are out here better than 2R, which act as gifts. And those happen. Like you have seen me in the last 2 months pull in trades that were 30, 40, 50, and 60R on things that move past 2R. Most of the time, they don't do that. So what I'm going to do is make sure that I keep paying attention to my job, which is mastering this space between -1 and +2, and being paid to trade, and then being open to the possibility of larger than 2R wins. But when I get larger than 2R wins, I treat them as a 2R win in terms of managing my average trade. This is ruthless risk management. Because I'll tell you what, when you get something that's coming close to 2, if you don't have that in mind, well, let me put it this way. I'm not saying you, because your psychology will differ. But in my world, in my experience, the ones that got to 2R, and I let myself feel, oh, this is the one that's going to work, and then it starts failing and failing and failing and failing, and I realize I'm giving back more and more and more of that maximum favorable excursion, and I let that go below an average trade, and it comes back and I just barely scratch. Oh, that's like driving a spike into my head in terms of psychology. So I'm not ever going to let that happen, ever. I never let that happen. And the ones that go to beyond 2R, I have a way of doing that. When you see me adding that second position before it gets to 2R, but I have positive momentum and it's cleared all the hurdles, I'm managing that one very carefully. And those trades that become 10, 20, 30, 40, 50R, I'm getting multiple positions on them, all paid for with markets money, and I'm never risking my seed capital on them. So that's just the way I do it. Now, what I'm going to invite you to do is really think about this and map your own histogram. If you know your histogram and you have lots of opportunities, you can make these adjustments to your exit strategy and how you want to play reentry and when you want to cash a winning position. I hope you suffer on that as much as I do. My job is to put you into winning positions so that you get to experience the suffering of exactly this psychological moment. And let me tell you, compared to the suffering of losing money and having a negative expectancy, hey, this is a pain that I'll take all the time. I seek out this pain because the other pain really sucks. This one is just the normal pain of going to work and having a job. So I don't worry about thoughts about, is this the one that's good? No, because they all look the same leaving the station. So I know how to re-enter, and I know how to get multiple positions on as this thing is approaching 2R. So that if it does break through, off it goes. Now here's why it so rarely goes beyond 2R. So these are the motivators of our monkey brain. Pain and joy. Pain really hurts. And fear comes from a healthy desire to avoid pain. Fear of pain makes you do things. The other one is joy. Now, joy really feels good. Hooray! Uh, Taken to an extreme, joy can be greed. Like, I got to hurry up and get this one because, and greed is actually associated with fear. It's actually the fear of missing out on potential joy that you can imagine. It turns out that the anticipation of joy is more powerful than the experience of joy. That the experience of joy automatically brings with it some moment of regret because we can imagine a future in which we no longer feel that joy. So even the experience of joy has a bittersweet component to it. So I'm not going to take more than a -1 hour loss. Just not going to do it. So I structured the trade in that way. But I'm not going to let my experiences and memories of joy and the greed of getting as much as I can and the fear of losing out on the joy, I'm not going to let those cause me to intercept my 80% of my trades where I am aiming, again, I'm aiming for 2. Stalking. And it's because there was some little signal generator. And a lot of my trades are based on there was a measured move up and then some abnormal move down. And because that is quite often caused by fear, this is more often an overreaction. That some selling leads to panic selling, leads to really panic selling, leads to an overreaction, which then says, oh, buying on dips. And so everybody that is motivated to buy on dips comes in, and then everybody who prematurely got out wants to come back in. So after a strong move, and then an exaggerated sell-off, this generates much more powerful buying pressure. Tremendous powerful buying pressure. Just to get back to what is perceived as the previous fair value was this, but everybody believes the real fair value was this because this was wrong and it should really be up there. So all this buying pressure is saying leg 1 back to fair value, leg 2 where it should have been if it hadn't taken that detour. So there's the 2 scoops that triggers all of this buying, which comes from a rational decision to play back to fair value and then to hold out for the joy and the greed, which triggers a fear of missing it, which is where all that buying pressure comes from. Oh, if there was a disconnect in the sound, sorry about that. The recording has all that stuff. God dang it. So, pain and fear triggers one category of our trades. Joy, which has a hidden component of greed and fear, is the other kind. So what you'll see is most of my patterns So most of my patterns come from abnormal pain. So as price is moving up and it does this little thing, little thing, little thing, each one of these little selling moments, when we measure them, are part of the normal sell-off that occurs on the way up. But when you get an abnormal, oh, that sounds like a harsh winter in terms of the SSC, the supported spring crossing, and the four seasons. Those are ways in which we can characterize abnormal selling or abnormal pain. The stronger the previous move, the stronger this previous move was, the more invested all the people were who were buying this on the way up. They're invested in that. And so when they see these little pullbacks, they buy on dips. And every time they do, under normal conditions, that's what contributes to this. But now when you have an abnormal move, now suddenly all of these guys who were vested in this strong move on the way up are saying, oh no, all my gains are going away. So they have some stop level in here. And if that stop is hit, that triggers panic selling, and that panic selling triggers negative momentum. So you might get 3 units of pain. Well, if the previous move was very strong, and the selling is statistically abnormal, then the buying pressure that finally comes in and turns this thing around is going to be amazing. What did we just see with the coronavirus? We had some Trump stock market that had gone to all-time highs. And then had a 40% sell-off. And we just had a 40% recovery. And it's within spitting distance of that previous high. This little fraction that it has yet to make up is trivial compared to this plus 40. But remember, if this is what everybody who was in a part of that feels was, hey, that's fair value because that's what I had. The maximum money you ever had is what you feel like you're entitled to if you are a herd animal. If that was at 100, this sell off to 60 feels like minus 40%, but a plus 40 on 60 is a 67% gain. So now you can just imagine as we come into the station and you only got like 5% more to go, the amount of extra gains compared to a plus 67 is trivial. So now everybody who bought into this on the way up has really tight stops and is concerned about not losing that. So now we're back to this scenario. Only imagine you were a person who didn't cash out, but who experienced a 40% loss, and now watch this thing come all the way back. Do you think that guy's going to let it go back to zero again? No. So that guy is motivated to protect, and all these people that earned on the way up are motivated to protect. So now we can say, what really happens? How many people really believe in this economic situation with an election coming up that there's another 40% above this? Do you think there's another 40% above that? On the basis of what? Okay. Belief and feelings? Fine. So this is a very real thing. Let me tell you who else is motivated by that. All the professional money who said that this was BS and who did not participate are looking at all of the newbies and the Robin Hood traders and the gunslingers and the amateurs. All the whole way up, these guys are saying, guys, this is not sustainable. This is BS. And as soon as this thing starts to collapse, in order to be right, everybody that didn't make money on the way up, all the professionals are going to want to crush that. How far can they crush it? Well, if they crushed it 10%, guess who's going to come in? The Fed, because the Fed is what drove that. $15 trillion worth of leveraged money turned that around. Do you think they're going to let that come all the way back here? They are not, because they don't have another 15 trillion to spend, or the game will be exposed for what it is. So there could be some sharp volatile selling. I'd be really surprised if it came all the way back to 40%. So there's a lot of tactical trading built in there. So I'm saying all that simply to say that Phil's question about what about ones that get away? I'm not worried about those because I know how to add positions. That's why I say you should watch the 2-hour battle drill every day for 100 days. Because now, when I aim for 2, I'm aiming for 2, risking 1, and now this thing opens in here and bang, I'm in, and it does this. If I didn't re-enter, in retrospect, that's a voice that says, I knew it. I knew it. I knew it was going to do that. You didn't know that. You couldn't know that. 80% of the time, it doesn't go beyond there. Only 20% of the time it goes beyond there. So when that voice is saying, from retrospect, I knew it, that's a voice that's trying to say, hey, you should take more risk down here. And I don't think that's justified. It is not justified in the patterns and in the trades that I'm giving you. And why is that? Because these are triggered by an abnormal sell-off. And it could have been this. And it had just enough to get in. Now, in the case of a collapsing dragon, all these guys are vested in the downside. And every little gain that you have attracts these guys to come in and make it a dead cat bounce, and so they can get another short position and they can hammer that. So the bigger the move to the downside, the less likely that this thing is to go to the upside. But remember, if this thing was a really strong move up, I said there was a lot of buying pressure coming in. Hey, the same guys who want to short the abnormal move up are coming in, and this is why you get such volatility, because you got a bunch of guys trying to short it, and now you got a bunch of guys trying to buy it. And when you get abnormal buying pressure and abnormal selling pressure, this is where you get these incredible volatile moves in both directions rapidly in a compressed period of time. And this is so anybody who can take their pieces out of this on the way up, and then on the way down and the way down, which we've had for the last 4 months, in this compressed volatility, you're getting hybrid trading that is not directionally biased, and you're making bank in both directions precisely because you're not tricked into believing, oh, this is the one that gets away. So I'm happy to get my 0.6s and 0.9s 5-10 times a day. And then occasionally, 20% of the time, something runs away, and now I'm going to have, because of the 2-hour battle drill, I'll have 2 or 3 positions on that, and that's going to be one that gives me 10, 20, 30 R once in a while. I'm not going to let the memory of those things change the way that I'm trading inside here. Because those ones that actually do run away, how many times in my trades do you see me not get those? Not very often, because the 2-hour battle drill is the gateway to those great big wins. That's the point that I want to make. So my job is to get you into the 80% of those trades that are going to give you a positive expectancy between -1 and +2. I want that to be positive expectancy. That's going to give you the money and the time and the confidence and the skills to refine your own personal psychology of when do you give it back, when do you re-enter, how do you get back in there. I'm showing you how I do that. But my primary job is to give you the time and space and money and lots of opportunities to do exactly that. So that's how I answer that question, Phil. This is almost an update to the 2-hour battle drill. You'll want to listen to the whole thing, even the piece that got cut out by the audio, where the audio went. You're going to want to listen to that again. So this is why I would say on an average win, like that's at 0.9, you should be at no lose plus dinner for. I'll even say, yeah, because that gives you, if that got to 0.9 and it's coming back, you're already at no lose plus dinner for 2. And now you can try to get better. Like you don't have to let it come all the way back. You can if you want, but somewhere around that average trade, you're going to want to, you'll end up taking a sniper exit or something, or you'll find your own personalized, psychologically satisfying moment. Don't try to do it just the way I do it. This is the area where you've got to study yourself. And this is called the Michelangelo effect. One of the things that happens in the COVID-19 experience, and this happened all the way through the hybrid trading workshop, by the way. So for 4 months, I've been kind of locked in my basement and doing distance learning and teaching for Colorado Tech and Central Michigan and the military college. Since about the middle of March, I've been working 16-hour days from my basement, uninterrupted, except for the last few weeks when we started the soccer camp. But I've stayed on the base camp here at the house for almost 4 months. Well, the Michelangelo effect is what happens when you go through an intensive period of introspection and self-work and focused attention on something that you care deeply about. And the net result of that for me is this final form of the hybrid trading workshop. You know, with the opportunity and the challenge of managing uh, our family's retirement accounts and for my extended family, and trying to give good guidance to you guys in the time of the virus, that was an intensely important period of time. Still is. But on 1 August, it kind of feels like, hey, we're into phase 2 of that. So that 4-month period of time was extremely important for the many people who are listening to me. And I feel the weight of that every day. So the Michelangelo effect is what happens when you go through a period of unusually intensive introspection, and you end up, developing new skills and new insights. And that's kind of what Michelangelo would do, is would just kind of go off by himself and fully experience the inspiration and work through his stuff in a very personal way, which is what made him Michelangelo. I'm not saying I'm Michelangelo. What I'm saying is that my job is to get you the templates and the structures and the systems to handle those trades between -1 and +2, where we aim for 2, risking 1, and our positive expectancy. The extra 20%, which is where you and your personalized adaptations come from, where you can get more, is based on how you approach the answer to this question, and that is, how do I manage the exits? The entries, dudes, I'm sure, even just taking the supported spring crossing katas, those things have at least a 50% win rate, and the payoff is better than, it's 3-2. You got multiple people that have taken this course in the last 8 weeks who actually haven't even taken the course, but who have taken just the supported spring crossing kata and have taken 200 trades and are positive expectancy just doing the kata, which is not even an optimized rule set, and are paying 3-2. So how many times do you want to trade that way? All of them. I'll trade that an infinite number of times. A coin flip that if I win, I get 3. If I lose, I lose 2. There you go. You don't think there's hedge funds that are interested in this? You bet there are. So don't change that architecture. That's 80% of the fight. The 20% is Phil's question. What do you do about the things that go beyond and come back, and that you didn't get back? Well, there's 2 answers to that. One of them is re-entry, and as long as you can let go of your ego, because it doesn't matter, because it's just the rule set, then you can get back in without having to worry about, man, the other one was premature. That's what I wanted to finish up with on that, was that statement about being premature is a voice that comes from the future, that looks backwards and then can point out with clarity, oh, well, you see, you shouldn't have gotten out, because look how much better it would have been. That's the voice of greed and fear and regret that you didn't get back in. So as long as you answer that voice by just saying, well, I know how to re-enter. And in fact, it's easier to re-enter than to enter. Why? Because the initial entry had greater risk and it already paid off and you made bank. And then the sell-off that got you out didn't even go back to the first price level, but it is resuming. That's a lazy W. That's the second leg up. So after a big sell-off, just using the rule of thirds. On the next higher time frame, and whatever that is. So if I'm trading on 1 minute, and I can see this amazing sell-off on the 3-minute charts, it's that higher time frame. But if I was on 3-minute charts, then I roughly round that off to 10. And if I'm on 10-minute charts, then that's the 30-minute. So this is where that RL 10, 30, 90, and 270 comes in. This is where those 3 legs of gains come from. So if we framed a trade in here, and we got in something like this, let me clean that up. Something like that, and we're aiming for 2, and there's the one we're risking. Remember, this thing goes up in leg 1, leg 2, and leg 3. And so if my average trade is 0.6 over time, that means that it got to like 0.9. And then came back. So we got something like a some kind of entry level here. Maximum favorable excursion. And then came back, and then we banked to 0.6. And then our average losses are minus 0.3. That's why I set that thing equal to 0.2 to give you even more safety of position sizing R. So 80% of the time, it stays in this region. Only 20% of the time does it get beyond. Why is that? Because there's such a commitment to the downside, all these guys that are pushing it down, that when they see a rebound of this magnitude, like a 1/3 retracement, that triggers them and say, oh man, now we're going to get a chance to come in and short this again. And then this is where the collapsing dragon comes in. So the collapsing dragon is my favorite one. What that means is that little rebound, that little dead cat bounce was just a blip that brought in a whole new wave. And then you'll see they're hoping that this is leg 1, and then this is the start of leg 2. So at leg 1, leg 2, leg 3, you're attracting all sorts of sharks that are coming in. Every little gain that you make inside here is attracting more of these sharks to come in and pulverize that. And that's going to keep happening. And those collapsing dragons are going to continue to be amazing because this is maximum fear. And that makes those moves sharp and massive. The moves to the upside are tentative, climbing up the stairs and then falling out the window. So the easiest trade is this one. So when you get up to 2R against all odds, and I'm not worried about the ones that get away because I know that because of the 2R battle drill, I probably got a couple positions in and I know how to add positions. And then this is the one that's going to lead to 20 or 30 or 40R. So if I got in and then I got out, I know how to re-enter and just get back in. That allows me to ensure that these big ones, I always end up getting a position on them. But if it gets away from me and I didn't get it, I don't care because I'm getting paid to manage this space inside here. So when we see 3 little legs up and that gives us 2R, you got to remember that that is just leg 1 for the next higher time frame. And if he comes in, he says, now that it got my leg 1, he's ready to buy it. That's where buying pressure from the higher, and then he's hoping for leg 2 and leg 3. So his leg 1 is our leg 1 and 2 and 3. His leg 2 is our leg 4, 5, and 6, 7, 8, and 9. So his leg 3, or his leg 2, is our leg 4, 5, and 6. His leg 3 is 7, 8, and 9. So it takes all of these guys coming in from higher time frames to pile on. So imagine you had your initial position, and let's say this is the one that just never even looked back, and it got all 3 legs of the next higher time frame. Your first position might have gotten 9, then your second position might have gotten 6, and your third position got 3. That's where those big multiples come from. And that's why I try to get that second position in and get that stuff to no lose plus dinner for 2. Because if my win rate is better than 50% and I'm getting paid 3 to 2, then my job is to take as many of those opportunities as I can and not worry about the ones that didn't go beyond 2R. Because the more of those opportunities that I get, some small fraction of those are going to be the ones that grow into those enormous wins with markets money. So markets, if I'm positive expectancy down here, positive expectancy, that's funding my interest in all these ones that go on to become bigger winners. And you got to remember, it's the higher time frames coming in. Nothing that we could see from our little vantage. There was nothing baked into the cake here that told us, this is the one that was going to go to 20, because they all look the same leaving the station. And more often than not, that selling pressure comes in and crushes it. And that's why I don't stick around. But if it gives me an up, I'm out, I'm back in, it gives me a re-entry opportunity, I'm all about that. That is in the kata, that's the supported spring crossing. It crosses, then you get out, and then it goes right back up. That's the supported fall crossing. That's the re-entry portion of kata number 1. That's the important point to take away. This is entirely psychological. And when you say, if you got out prematurely, it's only because in retrospect you're saying, see, because this went up, because this was the 1 in 5 or the 1 in 10 that went beyond 2R, I should now loosen up my restrictions over here? Absolutely not. What that tells me is that I got to have a way to re-enter, to shut that guy up, or to quiet that voice, which is really telling me, hey, there's these opportunities that are occurring often enough that we should do something about it. Yeah, re-entry and multiple positions are the 2 ways that we exploit those great big movers. And now you understand why I tell you that your job is to find the mover. That's why I try to get 1, 2, or 3 positions on quick to see which one of those is the mover, and then concentrate my effort on those once I find the mover and stay with it, because it's in play. It's in play that day, just for that day. My job is to find the mover. And now, if it was a mover today and really paid off, guess what it has a good chance of being tomorrow? Another mover. So that's why the three sources of candidates for me are continuation patterns from today, new signals for critical states for tomorrow, or three, all the usual suspects, the frog champions, which just have a nice orderly movement and give us some of these big wins periodically. SFC is summer, fall, summer on the MACD. Yes, yes, yes. There are hundreds of those examples in June and July, and we cover them extensively in the nightly podcasts. So going back through and listening to those podcasts are amazing. And now here's what the interns are doing. The interns have done this for us now. Here's Antonio's, and I just uploaded this one for you. Here's Antonio's breakdown of the hybrid trading workshop and his note sheets. There was day 1 from 6 June, day 2, 7 June, and these are all the topics. The very first thing we did, supported spring crossing, and then where to find the files and the flashcards and the job book. And then a discussion of the tortoise journey. Let me clean that up. So, day 1. This pen sucks. It's the software that sucks, sorry. So day 1, supported spring crossing. And then the breakout sessions in here. Managing your trading day from planning to execution, chain trading, regression lines, standard work, how to get started, frog champions, how to find them on the daily and weekend report. Day 2, trade framing in the yellow zone, how to use Basecamp in the collaboration space, how to find all the lessons in Patreon and Talent LMS, how to use the job book to get squared away, a detailed breakout of an EWZ trade frame, and then the Q&A sessions. Details, 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 with many examples. And then all of the nightly podcasts that show the bar by bar breakdowns of all these trade patterns. So that's the time breakout. And then here's Antonio's beautiful note sheets. "25 pages of notes, where each of those little breakout sessions, and here's the timestamp and the things that we're talking about. There's the supported spring crossing worksheet and flashcard. And then Antonio's beautiful note sheets. All the way through the 15 hours of the course, plus the first 3 weekends worth of the Q&A sessions, which had a lot of supplemental material. The other interns are working on doing exactly the same thing for all the nightly podcasts too. And we're done with this thing. We're going to have 100 pages of notes with details on all of the lessons from all of those days. And those are going to be posted on in the Talent LMS for those that have the that subscription level. So you have this set of note sheets to study. So if you didn't get a chance to listen to all of those, all of these videos are in Basecamp for you as well as in Patreon in course number 104. So that's everything I want to cover for today. We're getting ready to go move my daughter back to her new apartment at college as they're getting ready to start up tentatively the new academic year. So got work to do there. And sure enough, here we are, 90 minutes in, just never fails. That's what I got for you today. Take good care. I'll get this published, and then that audio glitch there in the middle won't be in that video. Okay? Take good care, and we will see you in the chat room. So no workshop tonight, because Saturday evenings is off. And then Sunday is the review of any trade frames you guys want to post in the campfire, and I'll comment on those. The last 2 weeks, there's been one, and you're missing an opportunity. If you value that stuff, do the work, post the charts in there, and I'll comment on them. That's how you get better. That's the best way to get better. That's the only way that you get better. So keep up the Sylvia, I will resend you the invite. Take good care, guys.